Welcome, friends, to the Probate Nation. I am Richard Ruddy. Our show this evening is about how to properly prepare the Testamentary trust account in Virginia. In preparing the account, it reminds me of a famous golf expression called the mulligan that comes to mind. This golf expression is named after a locker room attendant named John Buddy Mulligan, who was known for replaying his golf shots, taking do-overs, particularly on the first tee. Our experience is that you will get fewer mulligan opportunities for the trust account. And in fact, if anything can derail your trust administration journey more quickly, it is failing to properly account to the commissioner in a timely fashion. So the goal of this show is to educate you how to prepare the account properly the first time. And to lead this discussion, we are pleased to have with us Tim Grinnings from Grinnings & Low to walk us through the preparation of the account. But let me take a moment to tell you a little bit about Tim. Tim is co-founder of Grinnings & Low, a Fairfax City accounting firm founded in 2014. This firm specializes in Virginia inventory and account filings submitted to the local Commissioner of Accounts for Virginia estates, trusts, and conservatorships. Prior to forming Grinnings & Low, he worked as an auditor for the Fairfax County Commissioner of Accounts. Please welcome again, Tim Grinnings. Hi, Tim.
Hey, Richard. Nice to be with you again. Thanks
Likewise.
for having me.
Well, let's move quickly to the trust account form for just a moment and look at that top part of the form again, as we did when we looked at the inventory. So there's a lot of information that's collected there again. Can you tell us a little bit about what goes there and why we have it, why we need to put that there?
Yeah, so this is all just the identifying information for the trust. So you're going to have the beneficiaries, you're going to have the name of the trust, you're going to have the name of the trustee and the contact information of the trustee. You're going to have the dates that the account is covering and indicate also whether it's a first, second, third, or subsequent accounting on the top of this form.
Okay. And then I know we go to the actual full accounting, which you can see, which is it's a single page. It's 13 lines, so it seems like it should be pretty straightforward. But boy, a lot of people get really tripped up by that form, in preparing
that's true.
it. So let's just see here. So let's just talk generally. All of the receipts and disbursements that get reported on this form, do they need to be documented in some particular way?
Yes, everything that backs up the total figures that you report on this form needs to be itemized in a list. So you submit a separate sheet with everything itemized. So all the receipts, all the disbursements, all the sales, gains, losses. So every transaction that occurs under your watch as trustee, you have to then make a list of all those transactions and and then add up the totals, put the totals on the actual account form, and then submit it all attached to the cover page.
So as we go to take a look at the beginning assets, we took this information from the inventory. So when we filed the inventory, we didn't have to prove these numbers. So the numbers we're going to put on line one are not numbers we have to prove. But people should realize that when we get to the end, we have numbers that we're going to have at the end of the trust. We're going to have to prove those. So the time for proof is coming in case anybody was wondering about that. So again, is there any supporting documentation that we have to provide for the assets on line one as we start to fill out this form?
No, because if you're doing a first accounting, those assets have already been accepted by the commissioner on the inventory. So everything from the inventory is flowing to that line one, and that figure has already been accepted by the commissioner. And if this is a second accounting or a subsequent accounting, those values have already been verified as your assets on hand from the previous accounting. So you don't actually have to submit anything to verify those figures.
Okay, so let's look at that. We have lines 2 and 3. So it's interesting, unlike in some of the other reports, this one actually asks us to report principal receipts and income receipts. So tell me a little bit about, what is the distinction here between principal and income receipts, if you could?
Yeah, sure. So for principal receipts, it's going to be transactions like reinvested dividends, capital gains, or even receipts of additional distributions from the estate. So if this trust was created in someone's will as a beneficiary of an estate, so if an asset didn't get listed on the inventory because it wasn't distributed in time to be listed on the inventory, when that asset does subsequently get distributed from the estate into the trust, then that'll be a principal receipt. It's also acceptable to report that as an adjustment, but we can discuss that when we get to the adjustment section.
Okay.
An income receipt is would be things like cash dividends or interest or sometimes even short-term capital gains. And that's what would be reported as an income receipt.
Okay. So we showed a couple of reports up on the screen here. So the income receipts for line 3, you can see that your bank account, you have all that interest you're earning. You report every month what you received. You don't just do a total. Is that right?
Right. Every single transaction does have to be reported separately. List the date, list the bank account, last 4 digits of the account number, the amount that was received. All of that needs to be, and the date that it was received, if I didn't already say that. So
Okay. And then on the principal receipts, a lot of times I notice on the form that you worked up here, if I'm doing a dividend, if I own stock and I'm getting a dividend, but I'm reinvesting that, then I have to really show how many shares I actually acquire with my reinvestment.
oh yeah, you definitely have to show that because that factors into the verification of your assets on hand. As you alluded to, when we get to the end, you're gonna have to verify that you do actually have this number of shares of this stock. And if you don't record the increase in shares that you've reinvested and you now hold, then the value that you've got and the number of shares that you've got listed on your assets on hand isn't going to match the brokerage statement.
Okay, and then things are not going to balance.
Right.
Tell me, so are all receipts taxable income?
Not necessarily. You'll have to consult with your tax accountant on specifics, but generally speaking, I would not advise anybody to take the receipts listed on the account form and march down to the IRS and file those as income.
Okay. Um, and do we have to really we have to compile a separate sheet though to attach for each bank account or each brokerage account what's going on in there. Is that true?
Right. Everything, all the transactions need to be itemized. So you make a list of everything that's occurred in each account.
Okay. And then the documentation that we need to provide to support that would be the bank statement for every month, brokerage account for every month. What if I have no activity in a month? Can I just skip that particular form that month?
Unfortunately, no. You want to submit an entire set because the commissioner's auditors want to have a complete picture of what you've done with these assets that you're in control of.
Okay. Okay. So let's go to the next item that we need to talk about is going to be gains on asset sales. So I know we've got a PowerPoint that goes up there just so we can kind of see, but tell me a little bit about what goes on line 4 when we say gain. What do we mean by that?
So a gain is going to be so if you sell an asset and the proceeds from the sale of that asset are greater than the carrying value of that asset, the difference between those figures is going to be the gain on the asset sale.
Okay. Now, I think the thing is that people get confused about when we talk about gain, they think that we're talking about taxable gain that I got to put on my tax return.
Right.
Can you explain what the difference is?
Yeah, sure. So the gain calculated for the accounting form is simply based on the carrying value of that asset, which the starting point is the inventory value. A gain for income tax purposes could be or would be based on a different taxable base than the inventory value likely. So the gain calculated with using those figures is going to be different than what's on the accounting form in most instances.
Okay, so it is going to be important for folks to recognize as they receive assets that they get some communication as far as what is the tax basis for tax reporting, so that
Right.
they don't confuse that situation. So tell us some of the types of gains that would get reported here on this particular line.
Yeah, so anytime you sell an asset, so if you're selling stock, if you're selling a car, if you're selling a house, if the sales proceeds from that sale are greater than the carrying value of that asset, then that's going to result in a gain being listed on line 4 here and on this return.
Okay, and then the
On
types
this.
of documentation to support that. In the case of a house sale, we get like a HUD-1 or some sort of a transaction document that shows what happened, I suppose.
Right.
You have brokerage statements that actually will show, typically as part of their report, will show transactions during a month that can support that. The thing to be careful about there, I suppose, is that just because they show a certain gain based on their tax basis, that might be different than the gain you would show on line 4 for accounting purposes.
Right. So you're going to want to focus on just on the sales proceeds and then the carrying value of that asset.
Okay.
And that's what you use. You don't go and look at, because you're right, the brokerage statements will report, realized gains for this taxable year, and that's not going to be the same figure that you want to report on your accounting.
Okay, I can see where people could get confused. Now, line
Sure.
5 is called adjustments. So tell me a little bit about what goes on line 5.
So for trusts, typically adjustments are going to be used for making corrections to the inventory values. So if you didn't know the value of something and you valued it at $1 on the inventory because you had no idea what it was worth, and you subsequently determined it was worth $100, well, then you would list a positive adjustment of $99. And that's what we would use the adjustments for. Another thing that I alluded to earlier was it's correct to also report distributions from an estate into the trust as an adjustment. Or again, you can also report it as a principal receipt. Either would be correct.
Okay, and when we get that, do we need to have any documentation to support the value of that number at that time, or not?
Yes. So anytime you list an adjustment, you're going to have to substantiate that figure. So the commissioner's auditor is going to want to know why you're making the adjustment and see supporting documents.
Okay, all right. So then, and we can correct values if we're wrong. I saw that. So if there's market fluctuations in values from the assets I report on the inventory, do I report those as an adjustment?
No, it's never ever appropriate to report market value fluctuations on the accounting, because the accounting is only meant to report actual transactions that have occurred, not fluctuations in market value.
Okay, so that's very helpful, and then line 6, as we go down the accounting form, that's totals up line 1 through 5, so we get a number there, and then we move on to the more difficult and challenging work, which is lines 7 and 8, which are principal and income disbursements. So, so as a kind of a prelude to this particular discussion, can you talk a little bit about the importance of the bank that you select and how you set up the checking account for the trust?
Yeah, sure. So when you're setting up a bank account for a trust, you know that you're going to have to prepare this accounting, and you know that you're going to have to report and supply supporting documentation. So any payments that are made out of the trust have to be substantiated with a copy of a canceled check. So you want to make sure that whatever bank that you use has simple online access, and that it's easy for you to get copies of the canceled checks that you write out of that account.
Okay, yeah, some of the banks will automatically include those with the bank statement too.
Right.
So just be aware of that. But I do think that's very, very important. So tell me a little bit about what goes on line 7 and 8 as we begin to sort of distinguish between income disbursements and principal disbursements.
Right. So line 7's principal disbursements, that is going to be your trustee fee, brokerage account fees, legal fees. All of that is going to be on principal disbursements. But I want to point out that things like the trustee fee or any sort of accounting fees are split 50% between principal and 50% between income. So if you're taking a trustee fee of $10,000, you would record a $5,000 principal distribution or principal disbursement, and then a $5,000 income disbursement. Income disbursements, pure income disbursement would be, you've got real estate and you need a plumber to come out and repair a broken pipe. That would be coming directly out of income. And purely principal disbursements would be stuff like taxes. So those are some examples there.
Okay. And the reason these become important when a trustee determines what pot, whether it's the principal or income, where they're going to take it, can become important because a beneficiary might be the beneficiary of the income only.
Right.
And then somebody else might be the beneficiary of the principal. And so there can be disputes about what pot gets charged for various types of costs because it affects people's financial interests. And in fact, there is a new statute called the Uniform Fiduciary Income and Principal Act that kind of goes through, the kind of responsibility of a fiduciary to handle those things in a fair and equitable way. So we don't, prefer one particular beneficiary over another. So it can be very challenging to be a trustee of a trust. Cancel a check is a good way to prove the disbursement. Is there any particular, what type of proof is not acceptable?
Yeah, so a lot of times people will write a check and they'll make a copy of the check, and then we don't know what happened with it. So because we don't have the copy of the canceled check, so all we know is they wrote a check and they made a copy of it, but that doesn't prove that it was ever given to the payee that was written on the check. So that's an example of documentation that wouldn't suffice. Sometimes people will submit the carbon copies of checks. So, when I was an auditor, I would get stacks of carbon copies of checks, which doesn't tell me that the check actually cleared the bank or that someone didn't write paid to the order of someone else on the back of the check. So those are examples of documentation that wouldn't suffice, and along with unpaid invoices.
Well, that was the other thing I was going to ask you. In connection with the check, though, do you also need to provide the invoices that you're paying?
It's a good idea for the most part. It really depends on the jurisdiction you're filing with, but it's always a good idea to have the invoice that needed to be paid along with the copy of the canceled check that was paying that invoice. That's a complete set of documentation for that transaction.
Okay. All right, so the next line to talk about is line 9, and I don't think we need to spend too much time. This is going to be where we report losses.
Right.
And so much like with real estate sales or stock sales, we would report this information, and I know we have a PowerPoint that goes up there that kind of shows you how that would be handled, but I think that's pretty straightforward. It's just a reverse concept of reporting gains. Let's talk about distributions. Okay, so we have distributions of principal and distributions of income. And again, we get into that sort of decision, where is that money going to come from? Tell me a little bit about how this would work and what we're going to have to show people as we go about to make these types of distributions.
Yeah, sure. So with an income distribution, you're going to look at what were the income receipts for that year, and then what were the income disbursements for that year. And that net figure is then going to be what is available to be distributed to an income beneficiary, if any.
Mm-hmm.
And then for principal distributions, sometimes the trust document may state, distribute $10,000 of principal annually to this beneficiary, and then that's what would go on that line. Any specifically identified principal distributions.
Now, whereas we have to produce a check, cancel check, and so on for the disbursements of, can we produce a receipt signed by the recipient saying, I received check number so-and-so, and is that sufficient for documentation purposes?
Yeah, you would also want to supply the copy of the canceled check, but additionally, if you had a signed statement of receipt from the beneficiary, that's additionally what you would want to supply as supporting documentation for that distribution. And you can either create your own, or the Fairfax County Commissioner of Accounts has a template up on their website if you don't want to recreate the wheel. They've got a tried and true form out there that works.
Okay. All right, so then we go to line 12, and now we total up all of the assets apparently that we have. So tell me, we're collecting information here now both as to the carrying value, and then that goes on line 12. Tell us a little bit about the detail that we need to provide and the supporting documentation that they want to see.
Right. So for assets on hand, you want to supply the bank statement or the brokerage statement that shows the value as of the end of the covering period for the accounting. And that's sufficient. For things like real estate or automobiles, you don't really need to submit anything because the value of those doesn't typically change that much. But for marketable securities, cash accounts, you always want to supply the bank statement as of the end of the covering period.
Okay, and that's a PowerPoint that's up on the screen there that shows where you detail all that information about what you have on hand. So now, for the first time, this is your first accounting, you're now beginning to have to support the assets you actually have under your control.
Right.
Now, tell me a little bit about, now line 12 has to equal line 6, so those numbers have to work out correctly, otherwise we have a problem. Is that correct?
Yeah, so line 6 is going to equal line 13.
13.
If you've done everything correctly. If you have not done everything correctly, then those will not be equal. Most commissioners' offices, if there's some rounding errors, they'll allow an immaterial adjustment to be made so that you can get it to balance, but it's not usually preferable or acceptable to do that if you've done it the right way to begin with. But hopefully, having watched this program and paid attention to what to do on each line, people will be able to get line 6 and line 13 to be equal.
Well, as you look at the totals, though, you get down just below line 13. There's another line to put that says what is the fair market value of all those assets.
Right.
So tell me why that number is relevant.
Well, as trustee, it's going to be very relevant to you because that's what you get to calculate your trustee fee on, and it's also what the Commissioner of Accounts office will base their filing fee on, and it's also what the bond will be based on. So if that figure is in excess of the bond that you currently have, then you need to contact your bond company and make them aware of that and get that straightened out.
Okay. Now, I'm going to go quickly because we are getting very short on time. So they're eventually going to have to sign off on this thing, and you're going to certify that everything is true and accurate and that all the taxes have been paid. And I don't see a notice here about being under penalty of perjury, but you are certifying that everything's been taken care of. That's what we call a certificate of accuracy. And quickly, common problems that you see as far as auditor issues.
The biggest problem that we've seen would be just lack of supporting documentation. Just if I can stress something to everyone out there, that submit copies of the canceled checks, submit a complete set of brokerage statements, of account statements, because that is going to be necessary for the auditor to do their job.
And then finally, any closing thoughts, comments you want to share about the preparation of this account?
Yeah, the best advice I can give to someone trying to do this on their own is to do it on a monthly basis. Don't wait until the end of the year and try to compile all of this supporting documentation and all of these bank statements and get, signatures from beneficiaries. Do this on a monthly basis. Set aside some time every month. You're getting paid as a trustee, collecting your trustee fee. So think of it as, a part-time job that you have, and you set aside an hour or two every month at the end of the month to collect everything and put it all together on a monthly basis instead of on an annual basis when it may be overwhelming.
I couldn't agree with you more. I think that's an excellent suggestion. But Tim, I want to thank you again. You folks over at Grinnings & Low are great, and I want to thank you for taking the time to explain how to prepare properly the account form for a testamentary trust. Great public service, and I know it'll be very beneficial for those folks that have to take on this responsibility. So thank you again.
Yeah, no problem, Richard. Thanks for having me.
You're very welcome. For those of you inclined to prepare the trust account on your own, I think this show will provide you with some great guidance on how to do it properly the first time. But as Tim pointed out in his closing remarks, one of the key responsibilities of the Commissioner of Accounts Office is to trust but verify. So do not ignore a letter from the Commissioner's Office telling you of an error on the account or a need for supporting documentation. You will be given a mulligan and time to fix whatever is the issue, but there are no mulligans for silence. And if your silence continues, you may end up being removed as trustee. Should you find yourself baffled as to how to respond to the Commissioner, I suggest reaching out to an estate attorney or accountant for guidance. You'll be well served, and the Commissioner's Office will appreciate your diligence. Well, friends, this brings us to the conclusion of our show. I hope you found it helpful. Replays of the show can be viewed on the Probate Nation website and its YouTube channel. Again, thank you for visiting with us.